Financial Life. I'm Ed Elson, co-host of Prof G Markets. I'm joined again by Kyla Scanlon, economic commentator and author of In This Economy, How Money and Markets Really Work. Together, we will be answering your questions on the economy and what it means for your money. Kyla, thank you for joining us.
Thank you.
Are you ready to get into this?
Yes.
Our first question comes from Spencer Combs on Instagram. They say, quote, "It seems like a growing number of millennials priced out of home ownership and delaying kids are redefining traditional spending patterns. Rather than channeling money into homes and early family life, they're allocating more toward experiences, pets, and accessible luxuries. These categories may increasingly replace those older economic anchors. How do you see this generational reallocation of spending influencing the economy overall, and what opportunities could emerge as a result?" Kyla, what say you to Spencer Combs?
I think it's an interesting question, and it actually becomes an American dream question. So there's something called aspirational displacement, where people who can't afford to buy a house, which is that traditional path of the American dream, they start buying experiences, they start spending on their pets because they have additional income, but they can't, make a huge purchase like a house. And so it's an interesting thing that we're seeing in the economy. And on the previous episode, I talked about Baumol's cost disease and how goods were getting cheaper and cheaper because we've gotten better and better at producing them. Services have taken a longer time to get cheaper because it's much harder to make services more productive. It's very easy to automate a car factory, much harder to automate a physician. And so I think that's also part of it, is that it's much cheaper to access these accessible luxuries. We also have international trade, which has informed a lot of the access to these luxuries, oftentimes which come from abroad. And then the experiences part is a lot of travel too. And so the average American travels a whole lot more than they used to. And so these are interesting indicators of economic health. So a lot of people have a sense of financial nihilism because they might not necessarily be on the path that they want to be with the American dream, but they can afford these things. And so it does create a weird discrepancy in the economy where we see strong retail sales, but we see consumer sentiment so low. And in terms of how it's changing the economy, you see companies catering to it a lot more. Like there's a whole airline that caters just to dogs. I think it's called Bark. Have you seen this? Have you seen that? You can fly your dog on the Bark plane. Yeah. No, I'm serious.
Oh, God.
Yeah. It's something that happens.
Did not know that.
It's something that happens in higher income countries is, more and more so they'll spend on these sorts of things. It's the same pattern that we saw in Japan as well, South Korea too. So yeah, it makes a lot of sense. And there's going to be a lot of luxury brands that are able to capture that, a lot of dog airplanes that are able to capture that. And it does represent a strange amount of economic health.
I think the thing that's so depressing to me about it is it's like we don't have enough money to buy houses, but we do have enough money to buy flights for our pets. And that's such a weird, in-between stage, which is almost, I don't know if it's worse than not having the money to buy the dog flights, but it's definitely got a very depressing irony to it that concerns me. And it reminds me of also the little treat culture, which is this whole thing where it's like you don't think that you can buy a house or get anywhere because everything's way too expensive. So instead of saving up for these meaningful purchases, you instead just spend all of your disposable income on what people are calling little treats. So maybe the dog flight would be one of them, or clothes or Labubus or expensive coffee, whatever it is. Maybe you'd put sports betting in that category too, which is really concerning to me, at least, because it just makes me think that this generation has kind of given up and has decided that they're not going to get out. So why even try? And to the dog flights, I've got to look this up. Bark, that's crazy. So I have some data in front of me to the pet point. about how much young people are spending on their pets. So I guess this really aligns with what you've just said. So the average American across all age groups spends, if you have a pet, spends $4,400 per year on their pets. For Gen Z, the number is over $6,000. So young people are spending 40% more than the average pet owner. But here is where it gets worse. A third of those Gen Z pet owners say they have gone into debt because of their pets. So we're literally levering up to put our dogs on flights and get them fancy dog collars and maybe get them fancy dog treats. And meanwhile, the cost of housing is 6 times our income, and we're doing nothing, it seems, to figure out how to save for that event. And you can't really blame us because of the environment, the financial environment we're in. And I think this also goes to the stuff that we're seeing with like family planning, where young people just don't really want to have kids anymore. It seems like they're more interested in having like a dog or a cat or a pet because it's just less expensive. So I don't know what the question is like, what opportunities arise? I'm not seeing much positive in any of that, but I think that it is a really good question that highlights something that probably deserves more airtime in the young people conversation. And after this, I will be checking out that airline.
Booking
It's
your
crazy.
dog on the airline. Well, it does create, I think, yeah, I mean, it creates a distorted lens on the economy because, like, some people would be like, "Hey, they're buying their dogs airline tickets, things have to be somewhat
Right.
okay." So it is
They're
seen as,
fine.
yeah, it's seen as like, and they do have the money to do it. Like, it's well, they're taking out debt, but it's some element of economic health. And then it's just a shift in priorities too. And we often talk about this like fabled American dream. It's something I write a lot about because I think it's really interesting. Like, what does the society subscribe to as a path? And I think right now that path is evolving because of the economic constraints. Houses are just a lot harder to come by, and so it's harder to do family formation, to stay in one place even. And it's just a different world. And I think that it's hard, because for the past 40 years with this great moderation, where the growth of suburbia, the growth.
Because I mean, it really relates to what we just talked about, where if young people are out buying avocado toast and lattes, I feel like boomers immediately go, well, you can buy avocado toast, so you're fine. Everyone's fine. The first thing that comes to mind for me is like whatever avocado toast sales are, that would be a misleading economic indicator of what's really going on. But the one that bugs me right now is this interest that people have, and it's true, that more young people than ever before are investing in the stock market. Like it's something like half of us today, half of Gen Z, which is a record high. And then also like young people today are investing way earlier than other generations did. So it's like, okay, you guys have some money and you're interested in stocks, therefore you're good, like you're in good shape. And for me, this frustrates me because I feel like it ignores two really crucial things. One of which is how much are we actually investing? And the answer is it's really not a lot at all. Like if you look at Robinhood as an example, which is where most young people are trading, the average account balance is less than $250, which is tiny. So sure, we're investing, but we're not investing in a way that's meaningful, most of us, or at least on average. And then the second for me is like, what are we actually investing in? And for most young people, it's very heavy on the crypto and the meme stocks. And there was this Bank of America study or survey, they found that the average young person has 30% of their portfolio in crypto. That to me that's not healthy. That's not a symbol or a signal that young people are doing well. That's a signal that they're getting a little desperate and they're YOLOing into things where they might see perhaps a glimmer of outstanding returns. But the phrase, young people are investing more than ever in the stock market, like it makes you think that we're set. And I feel like there are a lot of other indicators, which we could get into, which I feel like are more symbolic of what's really going on, and that is we're not set.
No, I think that's true. And the economic indicator that I brought to the table is a bit similar, where people talk about how much young people are sports betting. 31% of 18 to 34 year
Yeah.
olds have an account with sports betting, as you were talking about. 32% of them bet three or more times a week. 30% has bet more than 500 in a single day. But when you ask them if they want this, people say no. A Pew Research poll found that over 40% of people aged 18 to 29 think that legalized sports betting is bad. It's up sharply from 34% in 2022. By the way, that matters. That changed. And so I think that's another thing that ties into what you're saying, is it seems like everybody wants to be betting. Everyone, even though it's not that many, it seems like a lot of people, but everybody wants to be betting. Everybody wants
Yeah.
to be a part of this like casino economy. But when we look at the data, that's just not true. Like they are that ties into the first question pretty well, where people are doing this because of the aspirational displacement. They're doing this because they're trying to find some way out, and because it's accessible. I think also prior generations might have tapped into this stuff a little bit, but I don't know. So I think one of the most misunderstood things is that people don't want what's happening right now with elements of the casino economy.
Yeah, that's a great point. It's like the same with any other addiction. Like,
Mhm.
you could be addicted to alcohol, you could be addicted to opiates, and then you can also probably think these things are terrible and I wish they had never entered into my life. I feel like the data that you're producing there is like that's exactly.
I check all of the major outlets, so Bloomberg, Wall Street Journal, Financial Times, to try and get a sense of what has happened overnight. And then I keep a running Word doc, Google Doc throughout the week, where I take notes on various themes that I think are popping up. So if I see a lot of research coming out about gambling, or if I see a lot of articles written about gambling, I'll add that to my Google Doc. So I try to compartmentalize and create themes for all of the things that I'm seeing, because then it's easier to connect the dots. Everything is connected in this sort of world. And so that's what I try to do, is make sense of it through writing it all down. But that takes a tremendous amount of time. So what I try to do with like arriving to a new perspective is say, okay, what did I learn this week? Like, how can I help explain all this stuff that's happening, and then relay it to somebody who's just trying to understand, and they have 3 minutes every day to understand what's going on around them. So there's a lot. There's a lot going on.
I feel like the other thing that you nail, which it probably helps with understanding things, is just like, how would I explain this in 3 minutes to someone who has zero context? And I feel like that's a really good way to understand the issues deeply. I mean, this is what people say, if you want to learn, teach, which I feel like is kind of what you do. And that's probably I feel like people could take that in their own lives. For me, same as Kyla, I try to read everything. So read all the papers, try to understand both sides of the argument if possible. That is always going to be helpful. I think another point that I would say that I think has really helped me is the fact that my job is to say stuff. And it's not just to read stuff. It's like I literally have to, by the nature of this job, I literally have to have a viewpoint, and I have to articulate that viewpoint out loud, which by its very nature forces me to be a smarter person. Like tomorrow, as an example, I'm going to be on MSNBC. I have no idea right now what we're going to talk about. They'll tell me in the morning. And then by the time I appear on camera later in the day, I need to have an understanding of what we're going to talk about. I need to have an opinion. I need to have a position. And I can guarantee you I'm going to have that because of the pressure I have to perform. I just will. Like, I don't know right now, but I know that I'm going to figure it out tomorrow. So I feel like the learning there, I mean, most people don't have a job like this. Most people don't have a job like Kyla does. But I still think there's something you can take with you, and that is if you want to connect the dots and be smarter about what is happening in the world, you should just make yourself speak more. Like you should say more things at work. When you're in a meeting, you should just force yourself to say something, have an opinion. You should have that pressure on yourself, maybe at a cocktail party. Like, okay, I usually don't have a thought, but I'm going to just take the risk and like say it right now. You should do it online. Like you should like post on LinkedIn. You should start a newsletter. Like I feel like the more you hold yourself accountable to producing thoughts and ideas, which is really uncomfortable to do, but the more you force yourself to do it, I think it really helps you connect the dots and also develop your own perspective. That might be kind of like an aggressive way to get it home, but I do feel like that's been a real benefit for me of doing this podcast and doing this stuff. It's like I don't have a choice. I have to have an opinion on stuff. And I feel like you can do that too in your daily life.
I think I'm just, I don't know if we need like more hot takes. I think we need more informed takes. And so I would agree.
Informed takes.
Yeah,
Yeah.
I would agree that like people should read the data, read the research, and then they should post on LinkedIn. I don't think they need to be just, that's not what you said. You didn't say that they should just like post on LinkedIn with whatever they're thinking about. But I do think
Informed, yes.
Yeah,
No, but it is an important caveat.
yeah,
Please.
I think it would do a great service to us as a capital S society if people were engaged a little bit more actively in how the news is impacting them. I think it's really important to not internalize it. It can be very stressful. Part of the media environment right now is a little bit of the flood the zone strategy where it is stressful by design. And so I think you kind of just have to know, okay, like what do I want to learn? Like what do I want to have a new perspective on? And then go and seek that out. And so I don't know if you have to like read everything all of the time because that just might wear you down. But if you know sort of what you want to be knowledgeable about, like is it, peptides, which is the new craze in Silicon Valley, like do you want to understand everything about that? Like you can go down that rabbit hole. So that's what I recommend is like read, stay informed, and then, know what you want to learn
Read
about.
and then speak.
Yeah,
Yeah,
crazy.
exactly. And I'm trusting Matt MC121 to not just spout off about shit that he has no idea about. I'm trusting you, sir, to understand the ideas. But I do think, again, hold yourself to it. Okay, I've read stuff. I've looked at all the perspectives. Now it's my job to say something to someone. I think that's an important step that you shouldn't count out.
Yeah, you have to approach this with kindness and empathy. So, like, one thing that I also do to sort of get rid of the noise is I talk to a lot of people. So I'm on the road quite a bit and I'm traveling and I'm talking to people who are real and like not on twitter.com. And so I think that's also important is like to talk to real people and not to let your perspective totally consume you to where you're not allowing any other input. It's really a tricky ledge to walk, but you have to make sure I think that you're open, not to be like too prescriptive, but I think you have to be open and you have to make sure you're approaching people with kindness because the world needs a little bit more of that.
That is a wonderful place to end. Kyla Scanlon is an economic commentator, educator, and founder of Bread, a financial education platform reaching millions through storytelling and analysis. She's also the best-selling author of In This Economy, How Money and Markets.
And those tariffs raise the cost of goods for, most Americans, a lot of small businesses, and just increase costs overall in the economy. But it's also important to remember that tariffs are essentially a version of a sales tax that is really disproportionately impacting kind of working class, poorer Americans. So I think on affordability writ large, the real challenge for the administration is that it's making the problem worse. And when you really go beyond just goods like groceries or just buying like soccer balls at your local Target to, things like healthcare, it's an even starker picture. So there, President Trump is the first president in my lifetime who has actually successfully taken healthcare away from people. He's the One Big Beautiful Bill Act will increase costs for millions of Americans by ensuring they don't have health insurance. The whole debate on premium tax credits, the Affordable Care Act, premium tax credits is also fundamentally about affordability as well. So I'm going to go with an F.
Saw that coming.
I know that might shock people. That might be it just was like I was really changing it up there. But yeah, I'm going with a failing grade.
I was expecting a D coming in. We went straight to the F. So there's a lot of different domains to dig into here. I want to dig into housing for a moment. We saw two kind of remarkable interactions last week. I'm just going to play these two clips for you, and I'd love to get your reactions.
There's so much talk about, we're going to drive housing prices down. I don't want to drive housing prices down. I want to drive housing prices up for people that own their homes. And they can be assured that's what's going to happen.
We are going to give guidance at some point to see what is a mom and pop. That someone, maybe your parents for their retirement, about 5, 10, 12 homes. So we don't want to push the mom and pops out. We just want to push everyone else out.
I mean, those two clips really made the rounds. I think the clip that I'd really like to get your reaction to is Trump saying that he actually wants housing prices to go up, which is quite remarkable because it seemed that he's been trying to present that he wants to address housing affordability. He's come up with some proposals that we can get into, but then he comes out and he just says outright, no, I want them to go up. What do you make of that clip? How relevant and important actually is it? What does it mean for affordability writ large?
We get a lot of conversation from Donald Trump, but every once in a while, he will just honestly tell you what he thinks about an issue. And I think this is really one of those areas. And, for people who understand housing in America, one of the big challenges is that it's a difficult issue, right? Because people who have bought a house, a lot of people's wealth in America is in their house. And so a lot of incumbents like to keep the people who already own a home, like to actually keep housing values up and sometimes oppose the development of additional housing in their neighborhoods, et cetera. But we're really living through one of the problems with that whole system, which is today, the average age of a first-time home buyer in the United States is 40 years old. Rents went up 30% from 2020 to 2023, and they've stabilized since then. And in some markets, they're coming down, but people overall have got a rent shock and a housing shock. And I think it really does say a lot about the president, which is, I think, the people he talks to on a regular basis, maybe the wealthiest Americans, really want to keep housing values up because it is key to their wealth. But for working class Americans, middle class Americans who are trying to buy a home or trying to just make ends meet by having an affordable rent, to say that you don't want any more housing means you want housing prices to go up. You want to make it harder to buy that home. You want to make it harder to afford the rent. That is what that means. And, I think it's just kind of a classic thing here, which is on tariffs, on this policy, on so much more. The great irony here is the president is making life a lot harder economically for working class, middle class Americans.
Do you think that quote actually means that we are going to have a policy under Trump of not building more housing? Because, I guess something that's been interesting to me is I thought that there were just debates over I thought we all agreed we want to get housing prices down. And then the debate or the divergence was like, how do you do that? Do you do it by addressing interest rates? Do you go out and buy mortgage bonds as Trump has proposed? Or do you He's even proposed that institutional investors can't buy single family homes. Do you just build more housing? That's been the whole abundance thing coming from Ezra Klein. And yet then he just says outright, no, actually, that's not our difference of opinion here. I want them to go up. Does that mean that we're actually going to see policies, you think, that will actually increase the price of housing intentionally? Is that what that means?
My interpretation of what happened here is the president might have been talking about lowering housing costs because his advisors tell him to say he wants to lower housing costs. It is a really deep concern for Americans. It's a really deep concern for young people, like people who are trying to buy their first home. People are in their 30s, 40s. It's like a lot of his constituents, it's people who voted for Donald Trump think housing is too high. So I think that is why his political advisors had told him that. And then I think maybe he was at Mar-a-Lago on a Saturday night where a bunch of really rich people said, well, more housing means that in my neighborhood, like Scarsdale or wherever people live, we would have more housing. And that nobody wants that. Nobody wants more housing in my neighborhood. Nobody wants to devalue my house. And I think this is an issue where you kind of have to choose. I mean, this is an issue about policymaking. And when you work in policy, you have to make a choice, oftentimes between two different groups. And, I thought that clip kind of just...
Why are healthcare costs still so high? Why are they so much higher in America? And then we kind of do the digging, and then it always comes around to some answer of, there's a lot of just complexity in the middle somewhere. There's the pharmacy benefit managers, there's the insurance companies. No one can see eye to eye on this stuff. The whole thing is just it's really complicated. That's the explanation. Could you just give us a 101 on what is going on with healthcare policy in America right now, and why hasn't America really gotten its act together in terms of bringing healthcare costs down?
The way I bottom line healthcare costs in America is the per unit cost of things in America is much more expensive. Going to a doctor, getting a medical device, getting a surgery is much more expensive here than in Europe or other places. Just anything you do is a lot more expensive in the United States. And the reason why it is a lot more expensive in the United States is essentially you have a variety of forces, hospitals, insurers, PBMs, drug benefit managers like middlemen, the drug companies, all very few of those forces are transparent. And so the fractured system allows a bunch of people to drive up costs. A big area where things are just much more expensive in the United States is hospital care. And those hospitals often have a monopoly. And no individual group is has enough market power to really drive costs effectively down. So it's a very inflationary system. So I don't have a much better answer than it's complex, and that's what makes it more expensive. But essentially you have a system that is super fractured, and in a way, everyone looks at somebody else to be transparent. What we should do is have everyone be transparent. The hospital should be really clear on what it costs. And, I do think that there is an additional problem in the United States, which is because people don't have health insurance, there are a bunch of forces, like hospitals shift costs. I mean, we've insured a lot of people in the United States, particularly after the ACA, but there are some people who still don't have coverage, and they shift costs to others to sort of pay for that. So it's two complicated things. But what we should do is have radical transparency everywhere, get rid of the PBMs. There's a lot of self-dealing in the system as well, and that would make it a lot better.
What could government do about this? What I'm getting is all of this fractured system, all of these independent actors, everyone's blaming it on each other, pointing fingers, being opaque. I feel like that's exactly the domain of the government to get in there and just figure it out. What would that look like?
There are states that have done really effective things, and I'll give an example. So it's to use the power of the government, not to set price caps, but to basically try to negotiate with all the insurers. Insurance is regulated in the United States basically at the state level for the most part. And so very similar to the German model, where you have kind of bargaining between all the employers and all the insurers to set, that the government kind of oversees to set lower prices for insurance. And they do the same thing with hospitals. And essentially, it helps bring the whole price system down by taking negotiating power and concentrating it. And this is why I think it's important for Medicare to negotiate drug prices, because you have something that has a lot of market power, able to match the power of like near monopoly prescription drug companies. So I think, other countries have used that model. Other countries have also done single payer, but in a system that's going to be, that you imagine, short of single payer, having the government help basically negotiate with employers and like bring all the employers together and renegotiate rates down in a way where companies can still be profitable, but you actually are concerned about consumer costs as well. I think that's an important step.
What is this administration doing on healthcare policy that you think is either a good idea or a bad idea? I think the one thing that I'm kind of interested in particularly is Trump RX. And from my understanding, it's, this policy to theoretically get the cost of drugs down. That's also part of his whole great healthcare plan. The details are like not very clear as to what he's actually going to do there. But just on healthcare, what do you make of what this administration has either gotten done or not gotten done so far?
The Trump administration is trying to lower healthcare costs and actually lower the level of federal payments to Medicare Advantage plans. So the Trump administration recently, tried to put the brakes on some overpayments to Medicare Advantage, which Medicare Advantage is a private insurance in the Medicare system, which historically has been, overcharging the federal government vis-a-vis, like much more than, it pays for traditional Medicare, fee-for-service Medicare that the government is just handling. So that's one area. And Trump RX, look, basically the Democrats in Congress passed Medicare drug negotiation. They have not undone that. And in some ways, it seems like they're trying to act like they're building on that by lowering drug costs. But, whatever, that's good. It's good that this is an area where they are trying to continue that work. And there are plenty of areas they're not continuing important good work. So, I think that's a really important step. I think the fact is that even Donald Trump recognizes Americans pay more for drugs, prescription drugs, than anywhere else in the world. And we do that at the same time where we spend.
Is that how you would describe your group right now, policy group, think tank?
Yes, I would say the Center for American Progress is an action-oriented think tank.
An action tank. And the fact you've worked in the Obama administration, you have a solid understanding of economics. What I want to do is sort of a lightning round here. I want to propose a series of policy ideas and get your sort of quick 30,000-foot action-oriented reaction. You ready?
Mm-hmm.
Single payer or national healthcare?
If America could start over again, there'd be a lot of benefits to single payer. It works well in other countries, but it would be a radical transformation today. So I support more of a public option to people that would create competition for insurance companies, and they'd actually have to compete on lowering costs vis-a-vis the government.
Mass distribution of GLP-1 drugs.
That would be great. I mean, GLP-1 drugs are they have many facets. One of which is the drug companies just kind of discovered, like, they basically struck gold with these drugs. They weren't expecting to, they didn't invest to have this kind of benefit. They are exceedingly expensive. They have huge costs, huge health implications. They would make Americans' lives much, much better on a whole range of issues. We're discovering health, sleeping, heart conditions, as well as weight loss. So it would be fantastic to get wide distribution and much cheaper price.
Federally mandated minimum wage of $25 an hour.
I think, we're looking at things like a $20 an hour. I think the most important thing to think about here is how you set a wage that people can live on and do it in a way that creates more job opportunities and doesn't give people an excuse to get rid of jobs. So, you could do $25 minimum wage and think of some regional variation. But I think the impetus to drive the minimum wage up is really crucial and hugely necessary. Just in much of the landmass of the country, it is still $7.25, just as a reminder. So think about what that's like. In most of the South, it's still $7.25. In much of the West, it's still $7.25. And I think that is outrageous, frankly, in this day and age.
Elimination of capital gains and mortgage interest, one basic income tax rate, and similar to what Reagan did.
I think the country, over the last 20 years, has seen a big increase in wealth that goes towards capital versus labor. And there's been some studies that show when you really raise capital gains that, people play games around that. But fundamentally, I think we should not have this big differential between capital gains and traditional income that benefits very wealthy Americans.
Last one, alternative minimum tax of 50% for anyone making over, say, $3 million a year.
Yeah, that sounds good. I think what I'd say here, and you've talked about this yourself. I think we have a real kind of cancer in the country in declining opportunity. And I'll also say, we had Raphael Warnock here at CAP a few months ago, and he was talking about, essentially a spiritual crisis in the country. And he identified it really with a sense that millions of Americans, most Americans, in fact, don't think that they have a real fair shot in the country. And they might think that because it's true that upward mobility has really declined. We have less economic mobility than Canada, almost half. We have less than most countries in Europe. This was a country that used to be a place where you could go as far as your talents can take you. So I think we have to transform our institutions to make them put that issue, like opportunity for every American, at the heart of what they do. And those ideas are part of that.
Last question for me, just along the lines of the lightning round. What do you think of the idea of the notion of mandatory national service?
I love it. I wish we could get it done tomorrow.
I would add one proposal to the lightning round. This has gotten a lot of attention recently. It's very controversial. It was proposed in California, and that is a wealth tax. Specifically, the one that was proposed in California would be a one-time 5% wealth tax on billionaires. Basically, for those wondering what is a wealth tax, it's just take your net worth and lop off 5%. What do you think of wealth taxes? Do you think they make sense? Do you think they will address inequality? What do you make of them?
Well, I think it's hard to do at a state level. I would say that. I think the fundamental impetus to me is how you address the inequality in the country. And I want to say a little bit more about that, which is I think we've had an important conversation about inequality for over, 15 years. Piketty's book came out like 15 years ago. And I think that we lose sight of how it's a corrosive effect, not just on our economy, but our democracy. And that billionaires today have the ability to have a billion times wealth of other people is one thing, but they also have a billion times more political power. So I think it is very corrosive. Now, I hate to be a policy wonk here, But there is some concern that a Supreme Court will never approve of a wealth tax because we needed an amendment to even get an income tax.
Yeah.
So I think, to me, the most important question is what ideas can we have, which there are many, to reduce the kind of overwhelming political power and economic power of the very wealthiest people in America. And I would just also note, if you just look at, say, the 1995 tax code, okay, it was in the heart of the Clinton administration. It had pretty high taxes, and the economy was doing very well. Okay, we were still able to have a tech boom. We had pretty high tax rates on income. We had pretty high tax rates on the highest end, and on capital gains. And we didn't do these 3 rounds of tax cuts that George Bush did on dividends and all these other things. We're just a wealth of areas that we have cut taxes on over the last 20 to 30 years that we could undo without the Supreme Court challenge or other challenge that a wealth tax would raise. And so it might be easier to start doing those and see where we land up.
I mean, yeah, I think this is hitting on what Scott often talks about, which is the difference between being right and effective. And, maybe a wealth transfer fixes things, just a one-time wealth tax, but is it actually going to get done? To your point, probably, almost definitely not. Are you proposing higher taxes in general, just higher tax rates? What are some of the ideas that you think are more likely to happen that would be more effective, more probable than a wealth tax?
So I think we should start with what our values are, right? Like, I think, we should reward merit in our country. We should ensure that, people can rise, etc. We shouldn't make it so much easier to have benefits of capital over labor. You should reward work. So if you those values, to me, mean that you would eliminate things like stepped-up basis, which is a way in which really wealthy people kind of hide money from taxes and enrich their heirs. You should have a higher estate tax, in my view. You should have raised capital gains. Increase, not lower taxes on dividends. There's just a whole there's a whole range of ways the tax code, particularly over the last 30 years, has benefited super wealthy Americans and benefited capital over labor. People are investing instead of people who are working paycheck to paycheck. And from my perspective, I think we should start. I think we should have a rich debate about a wealth tax, sure. But it's complicated. It's really hard to do. People can still hide assets and income. And so I think we could just start off making the tax code a lot fairer by unrigging it in many ways that it's been rigged over 30, at least particularly the last 30 years.
If you were the emperor of America for a day, so there's no Congress, there's no checks, no balances, you can basically just do whatever you want, you've got a day to do it. What would you change in the law? What would you implement and why?
I would ensure that we built mixed income housing in the suburbs and wealthier parts of America. And I'll say why I think that. Essentially what we've learned about poverty in America is that people who have access to wealthier places, poorer people who have access to wealthier places, their upward mobility goes up like this. Rod Shetty has done a lot of work in this space. And, to be candid, this actually is a bit the story of my life. My parents got divorced when I was really young. My father left just as a kind of accident of policy. Massachusetts had passed this encouragement of low-income housing in suburban areas. My mom was able to move into an apartment. We had really good schools. If she didn't have that apartment in a middle-class town, I could have grown up in a place where no one went to a college. I grew up in a place where everyone went to college. I went to college. I went to eventually law school. And I'm here because of all those decisions. So if I could change one thing in America just for a day, There'd be a lot of opposition from some like wealthy homeowners, but I would have a system in America where we integrated housing a lot more, allowed much more mixed income housing in places that are wealthier in the country. And I think you'd have a lot more opportunity for everyone.
Neera Tanden is the president and CEO of the Center for American Progress. Before leading American Progress, Tanden was the domestic policy advisor to President Joe Biden and director of the Domestic Policy Council, overseeing some of the administration's signatures.
I think that one was more offensive than funny.
It's always a really blurry line with these jokes, I gotta tell you.
Yeah. How are you? I miss you.
I'm doing well. I miss you. You're a busy man.
I don't know about you, and I mean this sincerely, I never miss people until I see them. I know a bunch of my friends from college, my fraternity buddies, are coming to our live pivot tomorrow in LA. And I never miss them. And then I see them and I miss them. The only people I've ever actually missed when they're not around are my boys. But when I see people, I'm like, oh, I miss this person.
Yeah, you kind of remember what it's like to be with them. Yeah, no, I feel that.
Yeah, that's right. What have you been up to? What have you been doing while
I've just been reading Epstein emails all morning. That's all I can do.
Let me guess, really good news for the president? He's been exonerated? It is a hoax, right? Nothing to see here. Move along.
I assume you've been reading them. I mean, I can't get enough of them. I love when these emails get leaked. I mean, the best was when Elon was buying Twitter, and then we saw all of the correspondence and the text between him and all of these Marshall Universe CEOs and tech executives. But now we're getting that with Epstein and Larry Summers. We got it with my old boss, Michael Wolff.
Yeah, he was advising him, right?
That's right. And by the way, this is what Michael does. I mean, a lot of people seem to want to think, oh, this compromises Michael Wolff. No, his whole thing is that he establishes relationships with all of these very precarious people such that he can get the scoop, which is why he released all the Epstein tapes last year. And as he said before, to almost no effect. People seem to not want to care about Trump and his very obvious relationship with Epstein. Either way, these emails are amazing, just for pure entertainment reasons. Will it go anywhere? Probably not. I don't know. But that's what I've been doing with my time.
I love how all of a sudden you're a guardian of a pedophile. You're an enabler now. You're making excuses for Michael Wolff. I don't know Michael, but I'm obsessed with his videos with Joanna Coles talking about, I mean, he has unbelievable sources, and I find him actually compelling as a journalist or an author.
Oh, yeah.
But I watched his video last night talking about it, and you could tell he was visibly rattled.
No.
Oh, I thought so.
No.
You don't think so?
I mean, of course, if your name is out there being released by the government, sure.
Affiliated with Epstein, giving him advice? Yeah, that would rattle most people.
He's released tapes with talking with Epstein before. We all know that that's part of his thing, was his friendship with Epstein, as it was his friendship with Steve Bannon and Donald Trump. Like, he does this.
Look who's triggered defending their enabling pedophile friend. Look who's triggered.
Like, you know what this means for you when you get canceled in a few years? This means what you know now is that I will be out there defending you.
Yeah, no, I get it. I actually, he was providing legal, or he was giving them counsel. I guess if you're going to get the kind of contacts and relationship that a guy like Michael has, obviously, that he's going to say, all right, this is what I would do, right?
That's exactly right.
What if it's like Max von Sydow in this great film, Hannah and Her Sisters, when his younger girlfriend is breaking up with him. He's like, you're my link to the outside world. You can't leave me. You're sort of my link to this world. I've been way too busy doing stupid stuff. What have been any other really interesting emails that struck you?
Well, one thing that is so striking about these emails is they're so poorly written, and I can't tell whether that's Epstein himself or just maybe the way these guys communicate with each other, but it's like there's no grammatical structure, and it's kind of hilarious. But the other thing, some of these emails are so petty. Like, he's giving relationship advice to Larry Summers, who's like annoyed about some relationship that went wrong, and he's doing it with all these other CEOs who are like, should I trust this woman? And Epstein's like, no, she's a hooker, like, fuck her. Like, it's very Boise, gossipy. Like, these people are still children at heart, even though they're kind of running the world. That's part of the thing that I love about it too. I mean, it's keeping up with the Kardashians billionaire edition.
It's funny. It struck me that if any of these people end up in prison, they should be forced during the release program to read Strunk and White's Elements of Style over and over again. I can't stand. It's something I inherited from my mother. My mother, despite leaving school at the age of 13, was kind of a grammar tiger mom. And I was just horrified. Chelsea Handler wrote an email to Pivot or an email to Kara saying, you have to tell Scott to stop saying anyways. And I'm like, oh, she's right. She's right. I should never say that. And I literally saw my mom going like horrified. Anyways,
I like anyways.
It's anyway.
I know it's anyway. I like how you say it, though.
I appreciate that, brother. You're being kind, and I appreciate how you've already committed to defending me when this all comes burning down in a house of scandal.
Gonna happen.
You know what? Should we get to the headlines?
Let's do it. Last week, we spoke with Professor Aswath Damodaran, and he said something quite striking. He said that for the first time ever, he is thinking about moving his money into cash and also perhaps collectibles. He said there is, quote, no place to hide in the stock market. And that was quite striking. He's not alone. Investors have been dumping the debt of America's big tech companies. Meanwhile, Goldman Sachs strategists predict that US equities will likely underperform global peers for the next decade. They recommended that investors, quote, diversify beyond the US. And then late last week, we saw a broad sell-off in tech stocks as many were worrying about valuations, and the economy and interest rates triggered another wave of caution in the investor community. In sum, Scott, there is increasing anxiety about the stock market, increasing bearish sentiment that isn't really being reflected in the prices of stocks right now, but at least it's being talked about. I mean, Michael Burry shorting NVIDIA and Palantir was quite notable, and we'll get into what happened there in a moment because there are some updates on that story. But I think the TLDR here is we're seeing a lot more people and a lot more respectable people such as Aswath who are saying, I'm not very convinced by the price of stocks right now. And perhaps we're going to enter a downturn. Now, I'm not going to make any predictions as to whether that's actually about to happen, and we can talk about that in a moment. But it was striking how bearish he was. So let's just start there. What were your reactions to Professor Damodaran and what he thought about stocks right now?
I think it's really powerful to have role models. There's just so many people out there who know more than you. I'm a big believer in experts or people that you look to for guidance around things. And if you have a little bit of success, it's so easy to develop Dunning-Kruger, where you think that you have real insight and wisdom across every issue. I suffer from that. And Aswath, I've known Aswath now for 25 years. Just looking back on every recommendation or piece of advice, nobody gets it right all the time with the markets, but generally speaking, he's gotten it more right than anyone I've ever met. And the thing I love about him is he's able to screen out his political biases. I have no idea what his politics are, but I remember when I was saying Facebook's going to get cut in half or Tesla, it was because I just really don't like these people. And he would just sort of say, oh no, Meta's a buy, it's a cash generating juggernaut. I mean, yeah, maybe it's bad for kids, but as a stock, you want to buy it right now. And I find that he generally is like one of these Josh Brown folks, and that he's like, what could go right?
Yeah.
And that he's like, you just want to have a bias towards staying in the market. And so it was the first time I sort of heard in his voice, like, yeah, everything's overvalued.
Yeah.
And it was rattling for me because I've known him for a quarter of a century. I have never heard that tone from him of just like, he was reaching so far to try and find value that he started talking about collectibles and just saying gold's overvalued. Just everything, even the defensive stuff. He's like, his basic message was, yeah, there's nowhere to hide right now because everything feels overvalued. And I started thinking, well, what does that mean? I would argue for someone your age, that means diversifying, but I think someone your age should always be in the market because you just don't know. And again, my other friend from Ritholtz Management, Barry Ritholtz, emailed me and said, I'm a big fan of The Economist called the crash correctly, the .com, and it called it in 97. I said, and the markets went up another 30%. And he immediately emailed me and said, Scott, you're thematically correct. But the NASDAQ actually doubled from 97 to 99. And so it's very hard. It's incredibly hard to time. I think people your age who have the longer time horizon and a greater risk tolerance because you can make the money back, be diversified, but I would still say be in the market. I think a guy my age or people my age who quite frankly don't have the time to make it back, I do believe, and it has, since talking to him, I thought, so for example, Apple and Amazon, which are still, I think, good stocks, I'm actually thinking about going. I have no leverage now, which is the first time in my life. I have almost no debt on my houses, and I don't think I have anything on margin right now. Actually, I have a little bit of margin on one account, but I'm actually thinking of substantially ramping down my exposure to the markets and not going into European markets or not reallocating into different asset classes, but quite frankly, putting 10, 20% of my liquid net worth, maybe 30%, just into cash. Because it did feel, he's been more right than wrong around this stuff. And I have never heard Aswath this bearish. And it wasn't panicky. He's not like that. He's just, look at this, look at this, look at this. It just feels relative to historical norms overvalued.
So much of this is about timing. And to your point of what Barry told you about how they said in 97, there's a bubble, and they were kind of right, but then the NASDAQ doubled. Just the perfect example of why you should not be trying to time the recession, time the correction, time the bubble bursting. Michael Burry just shut down his hedge fund last week. He deregistered from the SEC. He liquidated the fund. He's returning all of the money back to the LPs. And as Aswath said, he's probably right that that Nvidia perhaps is overvalued. Certainly right that Palantir is overvalued. I can put some force behind that. But that's not the question here. The question is, can you get the timing right? And the timing is almost impossible to game. I mean, he miraculously got the timing right in 2008. So he wasn't, and barely.
Barely. He almost got wiped out. And
now he looks like the clairvoyant, but there were plenty of clairvoyants back then, actually, who were saying this is probably bubble territory. What happened was he probably just got quite lucky on the timing, and then he made a killing. And then everyone said, okay, Michael Burry can see the future. But this is a timing problem, and you're not going to get the timing right.
That old adage, the markets can stay irrational longer than you can stay liquid. And it is Jim Chanos, this incredibly smart guy, short seller, he basically closed his fund. Julian Robertson, who was short all these tech stocks, basically closed his fund. He threw in the towel, one of the legendary investors in 98. And then ultimately he was right, but he couldn't stay liquid and couldn't, I was going short some of these companies by selling call options, saying, okay, Palantir, that makes no fucking sense. It made no sense at 70 times revenues. Well, now it's at 100 times revenues. So you're going to be more right than wrong when you have an optimism bias or constantly ask yourself what could go right. And when you go short stocks, you're swimming upstream because of demographics and productivity increases through innovation. The natural trajectory of the markets is up and to the right, and meme stocks go crazy sometimes, distinct of how insane it is that they're at these valuations. Even Jerome Powell said that these stocks are fairly highly valued. And the Shiller PE, which compares the S&P's 500 price to its average inflation-adjusted earnings over the past decade, is now higher than, get this, Ed, than it's been 99% of the time. And peaks in this metric have historically coincided with negative 10-year stock returns, including 1929, 1966, and 2000. And something else that Aswath said that really struck me was, it's not that means that in the next 90 days or next 18 months, we're going to wake up one morning and have Black Friday. He said, typically what happens is it just unwinds slowly. And so, for example, everyone talks about the crash. One of the things we got from our conversation with Andrew Sorkin was there really wasn't any one big day. It just kind of, the air just left the balloon over 2 years, 3 years. And if you invested in stocks, I think in the 70s, almost anybody woke up 10 years later and their portfolio was worth less than when they'd invested in 1970.
I think a lot of people assume that it's 2 or 3 or 4 years where you have losses. And usually, that is kind of the time frame. But we should point out, just as you're saying, there have been periods in US stock market history where the losses occurred over a 10-year span. So it actually happened in 2009. So in the 10 years before 2009, US stocks lost about 37% of their value. So basically what you're measuring here is from peak bubble in the next 10 years to 2009, you're looking at a huge destruction of value. So that is an example where actually there was a 10-year period where stocks went down quite significantly. And there have been other periods where you have losses over 10 years. As you mentioned, 1974, the 10 years before that, you had a period of losses. Also happened in 1939, the 10 years before that. Also happened in 1921, 1857, 1842. So the point being, what Aswath is describing there is you might have a decline in the stock market that lost 10 years. And by the way, we've actually seen 20-year periods before. It happened in 1932. The 20 years before that, stocks lost 14% of their value. It's happened also between 1837 and 1857, where stocks lost 10% of their value. So it does happen, actually. And I think this is probably a point that maybe we haven't been acknowledging enough on this podcast, is like, it's very infrequent and it's very unlikely in the large scheme of the US stock market. But it is possible, and even if you disagree with Aswath's position right now, you should at least consider the possibility that he might be right, that there is a possibility that over the next 10 years, the stock market could have a negative return. That's possible. Or at the very least, a lackluster return. That's probably probable. So you just shouldn't write that off. And I think it leads us to a place of, okay, what do we do about that? The first thing we have to do, we have to be mentally prepared and also economically prepared for the off chance that the next 10 years could be negative. And for different people, it means different things. For me, it doesn't really mean that much because I'm pretty young and I'm not really going to be selling anytime soon anyway. I just need to be in the market heads down. But it means things for different people depending on where you are in life. And I think what he brings up, and we can get into whether he's right, that is Aswath, but what he brings up is a very real possibility. You could have pretty negative stock market returns over a period as long as 10 years. It is possible.
You would normally think, okay, the Magnificent 10 are overvalued. I need to move to more overweight defensive stocks. But even these traditionally boring defensive stocks look expensive. Consumer staples such as Walmart and Costco, these are mature, low-margin businesses. They're trading at NVIDIA-level valuations far above their 10-year averages. And then you think, well, okay, what about alternative investments? Gold is up 55% this year.
Yeah.
On pace for its best performance since 1979. Okay, I'll put some money in Bitcoin. Well, that just touched an all-time high in October. And by the way, I finally threw in the towel and bought some shares in a Bitcoin treasury company. I like to talk about my losses, just not my wins. Got in at $14 a share. I think it closed at like $6.80. 50% destruction in like 2 months. The one place that Aswath said there might be value on a risk-adjusted basis, and it's my biggest investment, is real estate. He said, look, there's just a structural shortage of real estate. And we're short an estimated 2 to 3 million homes, and this shortage could, he thinks, be turned into an opportunity for investors.
Which is crazy, by the way, considering, real estate prices have also gone way up. Not as much as stocks, but still record highs.
I'm trying to think, okay, so if you don't want to go buy apartments and get your in-laws to manage them, which I have done, let's put those people to work. You can buy a REIT or, so for example, the iShares Core US REIT ETF, USRT, has both residential and commercial exposure and is only up 3% year to date. So I've tried to get away from making stock recommendations and just tell people what I'm doing, and then you decide on your own what you do. But I'm trying to find what I'll call special situations. So I'm now working with a fund actively trying to find tariff claims. And because I see that as something, I don't want to say it's disconnected from the market, but I would definitely call that a special situation. And then also I'm contemplating buying, and these are stories of privilege. I'm contemplating buying another home in Manhattan because of all of my assets, the worst performing one has been my home in Manhattan. There's some assets that have gone down in value, but New York real estate, I think the existential threat of the new mayor has been vastly overrated. All these idiots who say, I'm leaving. I'm like, okay, fine. See ya.
Good.
And I think New York is still singular. I think we're still going to continue to attract the secret sauce, and that, quite frankly, is Ed Elson and Claire Miller, who some of the greatest arbitrage or economic driver in history is really talented young people who are willing to work their asses off and take risks. That's the secret sauce of any economy. And more of that secret sauce is poured over Manhattan than any place in the world. There's just a lot of people, even I think much more than San Francisco, the most talented people in every industry have one thing in common, and they think, I need to kind of punch my ticket and get to Manhattan for a few years. And I don't think that's changed. And then I look at my place. I've owned real estate since 2017 in New York. It really hasn't gone up much. I did the numbers. I think it's up. I think it's grown about 2% a year. Now, that's not to say it's a buy, but I feel as if, okay, I was kind of hoping a bunch of stuff would come up for sale when Mondami was elected mayor. I haven't seen that, or when people thought he was going to get elected. I think all of this is like, I'll be at my sister's, and then that she's still around.
Exactly.
So I'm thinking about real estate, but also moving more into cash, because the way I've gotten into so much trouble, Ed, and snatched defeat from the jaws of victory, is I've always been so risk aggressive, as is the case for an entrepreneur. And it's really paid off for me until it hasn't. And that is being levered and borrowing money to start businesses and doubling down on stocks and borrowing on margin. God, it was fun from like 92 to 99. And then it became really unfun. And then it got so much fun again in 2001, and it got really unfun in 2008. And it's been disco since 2009. But now I'm thinking, okay, I don't want to go back to the it sucks part of the program. And so I'm thinking about substantially scaling down my quote unquote risk profile and shifting some money into cash and shifting some money into special sits that are somewhat uncorrelated, and into real estate.
Yeah, that question of like, how do you find the non-correlative asset is sort of the big question that every investor is asking themselves. And gold is such an interesting example because it's supposed to be like the anti-stock, the anti-dollar, and yet it's also having this kind of tech-like run-up. I mean, it's more than doubled in the past 5 years. Bitcoin, people said, was the same thing. And then, we've seen multiple times over and over again, it proves that it is in fact highly correlated with the stock market. When the stock market goes up, it goes up. When the stock market goes down, it goes down. So that has been a big question. And the question does then become, where do you hide if there's no place to hide? Like, where are you supposed to be finding value? And I think it's really interesting where your mind is going in terms of special situations, also perhaps real estate. That makes sense to me. But I think the most important thing you say there is more incentive, there is more reason today to start to think about de-risking. decreasing your leverage, figuring out where you're overexposed and trying to sort of reduce your exposure in those places. And I think that is the thing that people should be thinking about. If you're overexposed in any one company, which you definitely are because of how much tech has run up, don't sell it, but start to trim, start selling in very modest increments over time, not to eliminate the position, but just to make the portfolio more balanced. You shouldn't have more than 5% of your portfolio in any one stock. So that's the first thing. The other thing I think people should be considering more now is I think you should be considering the non-US stocks and the non-US index funds. I still do think, as we said at the beginning of the year, that there is value to be had in many foreign markets. China's trading at 15 times earnings. Brazil's trading at 10 times earnings. These are pretty cheap multiples. And that doesn't mean you should stock pick, but I do believe that kind of diversifying away from the US, which has had this massive run up, and congratulations, you've done well, especially if you're heavy tech. But I do think that we're approaching the time where you start to, gather up your gains and your wins and start to try to spread it out a little bit more. The other thing you could do, which I think is interesting, and Goldman has been talking about this too, is invest in the equal weight S&P. Because as we know, all of the returns have been concentrated into a handful of tech companies to the point where the S&P itself is not super diversified. I mean, NVIDIA is now more than 7% of the S&P. So that's just too high. You don't want more than 5%, as I said, in any one company. And if you're buying the S&P, you're buying 7.5% exposure to NVIDIA. So I think going equal weight, that kind of balances things out, and you'll be slightly less exposed to tech. And then there's what you say, which is cash. We'll get into bonds. There's fixed income, there's T-bills, there's T-bonds. You could even just buy a diversified treasury index, or you could just buy T-bills directly from the government online. But it does feel that we're approaching the de-risking part of the cycle. And that's not to say that tech could continue to run up over the next year, perhaps the next 2 years. But most likely, you're going to see some more modest returns if we're just looking at the course of history. And you're probably going to see some sort of correction. I will say I'm a lot less bearish than I think Aswath is, and I can get into that. But what you say there about de-risking, I do think that's important.
I'm still stuck on the part where you said it was really interesting where my mind is going. I think it's more tortured than interesting. And Ed, the idea of you having real insight into what the fuck is going on in the shit show funhouse of horrors in my head is so frightening to me. You would call your parents and say, I love what I'm doing. I'm making really good money. I love my colleagues, but I just can't be anywhere near this freak show called Scott Galloway. So be careful. Don't open that door.
I try to moderate my exposure to your mind, similar to portfolios.
People say, oh, he's an introvert. He doesn't like people. That's not true. I just want to make sure people don't really get the full picture of what's going on here. But as usual, a lot of what I said, the data is not supporting. The team did some research. So New York real estate isn't outperforming the stock market, but it's been a decent investment. The average yearly rate of return on investment has been 5 to 7%. I'd be curious what the luxury market has done. But if you put money away when you're 21 and it only grows 6 to 7%, keep in mind you'll have 31 times the amount of money when you're retiring.
Well, I will say only someone in your economic weight class could buy it. So I agree with you in the directional strategy. But this whole conversation is premised on this very bearish thesis that Aswath Damodaran seems to have, which is he thinks the stock market's overvalued. He wants to get into perhaps cash. He wants to maybe look at, fixed income, or at least make that a large part of his portfolio. I just want to end this by saying, maybe he's right, but I'm nowhere near at the level of bearish that I think he is. I still think that there is a ton of value in AI. And I think there are plenty of tech companies that are not that overvalued and that are actually very well diversified and that are being managed very responsibly. Of course, there are companies that aren't. OpenAI is an example. We went over that last week. But I think there are companies that are good. And I think one great example would be Meta, which is trading at 20 times forward earnings, which is actually a little bit lower than the S&P average. And yes, they are investing heavily in AI, and maybe it doesn't work out. But unlike OpenAI, they actually have the money and the cash flows to actually do this. They can withstand a correction, and they're doing this in a reasonable way. So even if we do see a correction, even if the AI bubble pops, Meta is going to be fine. Business is going to still be running very strong. They'll have plenty of cash. It's a great company, great fundamentals. Another example we've talked about is Amazon. Stocks had a pretty big run up over the past few months, so closer to fully valued than it was before. But having said that, just in terms of this AI bubble, is it causing, huge overvaluations? ChatGPT was launched in November of 2022. Amazon was at 176 at the time. It's at 240 today. So over the past 3 years, that's a 36% return. That's an annual return of around 11%. That's not that crazy. I mean, it's a little bit more than the S&P's historical return. So if the AI bubble is causing one of the most AI-exposed companies in the world, which is Amazon, the data center juggernaut, if it's causing that company to yield an 11% annual return, that would mean that either we're not in that much of a bubble or the bubble hasn't really infected Amazon that much. But I do think there is still value, and companies will get hurt. But as we discussed before, it's the companies that are biting off more than they can chew, that are extending their leverage out too much, that are becoming too dependent on this future vision of AI and not the cash flows they can bring in today.
Again, every year we do a big tech stock pick, and we're careful to say outperform the rest, because my belief is if the rest of the Mag 10 goes down 50%, I think Amazon will go down less. There's no safe harbor here. If there's a kind of drawdown that I think we're due for in AI. But the reason why Amazon has underperformed, despite the fact that they are positioned to benefit from AI, is that their cloud, which is has the greatest market share of the cloud providers, is seen as not as AI enabled. And so it's actually this notion that their cloud offering has developed a reputation as not being the most AI enabled or friendly or AI adept cloud, which I think is kind of not I mean, their stock hasn't underperformed. It's just underperformed relative to its peers. And what Aswat said is these companies just haven't made the kind of all-in bets on AI that everyone else has made. If he said, and it really shocked me, that NVIDIA was the most, the scariest one and the most overvalued. And I said, well, what about Palantir? And he said, oh, well, you've gone from the Magnificent 7 to the Magnificent 10. I would say Palantir. But you brought up something that is actually overlooked in the world of investing. And that is, every board I've been on, I feel like I come in and I talk to the guy, or when a CEO's on the call, I can usually tell when we're about to have a board meeting, and that is, the CEO starts getting defensive, and you can just hear this strain and anxiety in his or her voice. And Karp and Altman have shown uncharacteristic stress and defensiveness in their voice recently.
Those are dangerous positions.
Well, we forget these people are human. There's no way for them just to compartmentalize everything. And I get the sense they know they're out over their skis, and people are asking really hard questions they're having a tough time giving good answers for.
OpenAI, 100% in a very dangerous position. The response from Sam Altman is a total tell. Also, the numbers are a total tell. Very dangerous. By the way, if OpenAI goes out of business, and there are real concerns as to what that could do to the larger markets. But say they go insolvent, or there's some issue with the timing, or they go bankrupt or whatever. I mean, what's going to happen to them? If we're being realistic, they're just going to be folded into Microsoft. Like Microsoft already pretty much owns OpenAI. They own all of the IP. They have access to all of the IP. They have a substantial ownership over the profits. Like in that scenario, I don't think it just takes down the whole market in a really big way. It's going to take down certain companies. Like Oracle, as an example, would be a company that's going to get massively beaten up because of that, because they're so leveraged basically, and they have these contracts with OpenAI, which would put it in a really, really dangerous position. But again, there are companies that are managing their balance sheets fine. Microsoft's doing a pretty good job of it. Meta's doing a good job of it. Amazon, Google. You know, I'm less concerned than I think some others are. And so I just think it's important to like give both sides a little bit of weight, because I don't think the takeaway from this is, you need to sell, you need to get out of the stock market. It's still an open question. And we're obviously going to keep on looking into it, but I just don't want us to conclude like, oh no, Aswath's worried, I should be worried too.
Okay, so OpenAI, last round was $500 billion. If that company were to go away, first off, you're right, it wouldn't go away. It would fold into Microsoft or something else at, say, a valuation of $100 or $200 billion, a destruction in the private markets of $300 billion. That's big, but it's not going to take down the economy. The reason it would take down the economy or have a serious impact on consumer confidence amongst the wealthiest 10% who are responsible for the consumer spending, this is the domino effect. And that is, if OpenAI gets the shit kicked out of it and announces it's just not growing the way it hoped, they're the canary in the coal mine for NVIDIA, which is a $5 trillion company. NVIDIA goes down 80%, which is just not unthinkable. That's a $4 trillion destruction in capital. There's no way that wealthy households all over America don't go, oh, fuck, and start pulling back their spending, which has a disproportionate impact on the entire economy. I mean, so OpenAI is not the biggest domino, but it'd be the first domino that starts tipping over much bigger dominoes. Ooh, that was a good analogy.
NVIDIA is definitely a big question mark. It's tough because the valuation, I don't think is completely crazy, because the growth, the fundamental growth has been crazy. So, I mean, the business is on a tear. I think it's a model that outperformed OpenAI and Perplexity across several benchmarks. Plus, it is 4 times cheaper to run at scale than GPT-5. This news dropped just days after Jensen Huang told the Financial Times, quote, China is going to win the AI race. He later clarified that China is, quote, nanoseconds behind, and that the US needs to win by racing faster. But clearly this issue is top of mind for him. Scott, another new model out of China. This one is called Kimi K2 Thinking. It's from this company Moonshot. It cost them $4.5 million to train it, which is 1,500 times less than what OpenAI spent on R&D this year, outperforming OpenAI's models, outperforming Perplexity's models, a lot cheaper to run. We've been saying this, China's just going to flood the market with cheap AI. Here's another one. Your reactions.
If I were advising Xi and I was the head of the CCP and strategy, I would be doing exactly what they're doing. And that is, I'd say, I know, just dump a bunch of cheap, outstanding AI into the market. It's going to put real pressure on these companies that are driving the majority of the American market, which is driving the economy. And we're just going to kick them so hard in the nuts. This is our biggest prediction for 2026. That the AI trade unwinds in the U.S. at the hands of government-sponsored subsidization of Chinese AI, and they're going to do the equivalent. We used to bitch about them dumping steel, I think, into the U.S. market in the 80s, thinking if they sold steel below cost, they would consolidate the market, put all U.S. steel manufacturing out of business, and then consolidate the market, similar to what Amazon or Netflix have done. I think they're essentially engaging in in my opinion, is this true? The most seminal geopolitical action right now is Chinese dumping of AI. Your thoughts, Ed?
Well, I think the most important thing is the price. So Kimi K2, 4 times less expensive than GPT-5. So, I mean, we've discussed the pricing before, but let's just go through it again so people understand. So Anthropic, or Claude, It costs $15 per million tokens. GPT-5 costs 10. Kimi K2, which is this new Chinese one, is $2.50. Quen Plus, which is Alibaba's one, that's again Chinese, $1.20. And DeepSeek, which everyone knows is also Chinese, $1.10. So they're producing comparably performing AI that is, in some cases, 10 times cheaper than America's models. And the question that you have to ask is, okay, why is it so much cheaper to create AI in China? That seems like a pretty fucking big deal. The answer is energy. It's because China produces way more energy than America, double the energy that America produces. And where are they leading? You look at the statistics, it's renewables. 2 times more wind power, 3 times more solar power, 6 times more hydroelectric power, and they are continuing to invest in renewable energy. And so that's why electricity in China is cheaper. It's more than it's less than half the cost of energy in America. And so it's just so funny because why are we not investing in energy, specifically renewable energy? Because we've decided that it's woke. That's the only reason. And it's happening as we speak. They're terminating grants. They're making the permitting process way more difficult. If you want to build a solar project in America today, there's a new rule where you now have to get a personal sign-off from Doug Burgum. That's their big new energy policy. Doug Burgum has to say yes and give it the okay. I mean, that is just a bureaucratic nightmare. And again, why are we doing it? We've decided it's woke. There's no other reason. And it's just so funny how the anti-woke movement is like the new woke movement. It's the same groupthink, ideological capture that led us down arguably some questionable paths during the woke era. And now it's happening in reverse. And we're falling behind on AI. The reason, again, just connect the dots. The reason that the models in China are 10 times less expensive is because of the energy costs. It's because they produce way more energy. And they haven't decided that building a solar farm is woke and indicative of liberal capture. So, I mean, there's a pretty clear thing that we need to do here, and that is, for whatever reason, clean energy, renewable energy, green energy has been classified as woke, and Republicans refuse to touch it. And in many cases, they go in and they cut the funding and they gut those projects. So I don't know what we need to do, Scott, but you're the branding expert. How do we rebrand renewable energy as not woke? How are we going to do that?
Well, that is in the number one New York Times bestselling book, Notes on Being a Man, which, by the way, you did not bring up. You did not bring up. So
I brought it up last time.
Everyone's using this term toxic masculinity. I don't think there's any such thing. I think there's cruelty, criminality, abuse of power, but masculinity should be an aspirational thing. But there's a weirdness around, I think Trump flying into the quote unquote, not masculinity, but into this faux weird coarseness plus cruelty equals masculinity, fucked up sense of gendering things, that it really worked for him, unfortunately. And so now he's trying to, anything that feels progressive, is feminine, is weak, and should be ignored. But what we need to do somehow is make smart equal patriotic, equal cool, equal. It doesn't even need to be a gender. De-gender it, for God's sakes. Texas, which is not known as a progressive, you might even argue like Old West masculinity or whatever, or Old South, I don't know what the term would be, Texas, they have more wind power. They're the largest producer of wind power in the nation because the economics work. But this stupid feminization and conflating renewables with femininity and progressiveness, which they then say are bad things. And we need to, if we're real men, we're going to go after oil and like whatever pollutes the most. That's me strong like bull. okay, just put that shit aside and say, I understand the notion that if we should have strategic oil reserves, we should continue to drill. The greatest arbitrage in history is fossil fuels, and we need to be mindful of climate change, but pick your poison, and we have to be economically competitive. I get it. But to decide that somehow renewables make you less manly, which is some fucked up way conflated with leadership, such that you ignore, the renewables, which, I mean, at a very basic level, we don't know where oil is going. We don't know if it's going to spike to $200 a barrel or going down to $10 a barrel. It is really hard to predict the price of oil. It is a fairly safe prediction that in a decade, solar and wind are going to be less expensive than they are now. Every year, technologies march around battery technology, around the dynamics of trying to get more energy from a rotating windmill or a hydroelectric capability or so. Every year, it gets cheaper and better. And there's occasionally a blip up, but for the most part, the investment, especially by the Chinese in renewables, which has been much more dramatic than us, they are very good at scale in figuring out a way to drive the cost down. Their strategy is the same as Walmart or Netflix or Amazon, and that is push your costs down, pass on those price decreases to the end consumer, consolidate the market. They're about market share at a lower price. That's their economy strategy is the same strategy as Amazon, Costco, Walmart. Our strategy in the U.S. has been to elevate perceived value through IP protection and branding and innovation. We have different, we go at different sides. And some people would argue that China is moving up the food chain and now getting an innovation around automation and robotics, et cetera. But this is a really good bet on renewables for any other reason. I am 98% confident renewables are going to be less expensive in 10 years than they are now. I have no fucking idea where oil is going to be. And so it just seems, okay, how do we make smart and competence aspirational and cool again, as opposed to offending people and going back to the 50s, including the way we treat immigrants and non-whites and women. Somehow that's cool and masculine and macho. So I do think there needs to be a rebranding of, and to a certain extent, we stuck our chin out as progressives. We said, okay,